Good morning, my name's Charles and this is Jonathan joining me from Affinity Private this morning. Today we'd just like to run through some of the changes to the laws that were discussed last week regarding these superannuation changes that were brought up in the budget earlier this year. Jonathan, firstly, what are the changes to those existing propositions that were announced back in July?
So there was three main changes that got announced last Thursday by Scott Morrison. There was obviously a considerable amount of debate between his own party around a couple of the changes, and there has been some compromise. So the first one was to do with the $500,000 lifetime non-concessional cap. There were many that thought that that change was retrospective in that it looked back at contributions that were made from 1 July 2007. So that $500,000 cap has been scrapped and replaced with an annual limit, which is similar to the way it is now. So at the moment there's a limit of $180,000 per annum. Going forward from 1 July next year, it'll be $100,000 per annum. There is a slight catch, however, and that's that your balance must be less than $1.6 million as at 30 June in the year prior. So it's basically saying that $1.6 million cap is the limit that we're happy for you to have inside superannuation. The other two changes were a bit smaller, but they did actually impact the bottom line of the budget quite heavily. So the first one was to do with those aged over 65. So essentially they were going to remove the work test and allow anyone to contribute. That's now been reinstated, so you need to do 40 hours work in the 30-day period, and that has to be for gain or reward. On top of that, they've also pushed out the start date for one of the key changes in the budget, which was to do with the ability to catch up on prior years' concessional contributions. Those made from your employer, and essentially you could catch up the previous 5 years of unused contributions. So particularly helpful for those that were self-employed or lumpy incomes, or those that have had a break from the workforce. So that's been pushed out to 1 July 2018. So those changes have recouped the money that's been lost by scrapping the $500,000 contribution cap.
Right. And just as a bit of a refresher for our clients, what were the changes that were originally announced earlier this year that have ended up passing through?
Well, there were quite a few, and one of the key ones was to do with the purpose of superannuation, and that's been very clearly stated now to supplement the age pension, and that's a bit of a change in the rhetoric. And the way they've structured that change up is that all future legislative change must be seen in the context of that particular goal. So that's quite important. On top of that, the one that's going to impact some people is the $1.6 million cap on the amount you have inside a pension. And that's a firm cap from 1 July 2017. So anybody that has more than $1.6 million will be impacted, and those that are also looking to accumulate more than that will be impacted as well. So that is a pretty major change. The other one that's probably relevant for our clients is the self-employed person's changes. So previously there's been a bit of a quirk where you couldn't have more than 10% of your income coming from an employment source. That's being removed to allow it easier for people to contribute to superannuation.
Okay, and I guess the big question is, how will these changes, how do you foresee these changes impacting our clients?
Well, there's an opportunity between now and 1 July 2017 to utilise the higher contribution cap. So it is $180,000 this financial year, and the bring forward rule allows you to grab the next 2 years of contributions and put them into superannuation as well. So in theory there's a $540,000 limit as long as you haven't contributed in the last few years. So the opportunity there is to either add more money to superannuation or to look to adjust the balances between spouses, keeping in mind we've got that $1.6 million cap. There's also probably an opportunity there to review the estate planning implications of superannuation and whether we can look to increase the effectiveness of money passing down to the next generation. The other point I'd probably raise is that these changes definitely incentivise people to look at superannuation earlier on in their life. So start contributing at 25 or 35 rather than thinking about super once you turn age 50. So that'll be something we'll talk to our clients about, particularly with their children as they start to enter the workforce and start to accumulate capital.
Great, thanks Jonathan. And as we mentioned, we'll be going through our clients on an individual basis, as not all situations obviously are the same. So if we believe that we can add some value there, we'll be contacting you regarding these changes. Thanks for your time this morning.
Thank you.